So let's talk about a real puzzle happening in the US stock market right now. It's been a pretty fantastic year for investors, but lately, it feels like the entire market is just holding its breath. We're going to dig into why that is.
And really, this is the million-dollar question, isn't it? The numbers on the surface look great, but the mood, the vibe, it's tense. So what's the deal with this disconnect between really strong performance and this feeling of deep uncertainty on Wall Street?
I mean, what a performance it's been. This number right here, that's the S&P 500's gain year over year. A climb of nearly 16% is impressive, no matter how you slice it. That's the kind of return that should have champagne corks popping. But they're not.
And here's the catch. Instead of rocketing even higher, the market's kind of hit a wall. It's consolidating. That's just a fancy way of saying it's moving sideways. We're stuck in this really tight trading range, volatility is low, and it's all happening just a stone's throw from all-time highs. It's a big pause. The real question is, a pause before what?
Well, the answer to that question pretty much boils down to one single word: inflation. The entire market, I'm talking the biggest hedge funds down to the smallest retail investors, everyone is completely fixated on one specific economic report that could really set the tone for the rest of the year. Okay, so if you look at the calendar for this week, it is packed with big events. You've got GDP data, a rate decision from South Korea, but you can pretty much ignore all that. All eyes are on that highlighted event for August 29th, the U.S. Core PCE inflation report. That is the big one. This is the single data point that has the market totally frozen in place.
You might be asking, what on earth is Core PCE? Well, let me break it down. It stands for Personal Consumption Expenditures. The core part just means it strips out the crazy swings you see in food and energy prices. But here's the really crucial part. This is the Federal Reserve's favorite measure of inflation. It's the one they watch most closely. So their decisions on interest rates, whether to hike, hold, or maybe even cut, are massively influenced by this one number.
And here's what the market is desperately hoping to see. The general forecast is for a reading of 0.2%. That would be a little bit cooler than last month's 0.3%. Now, I know it might not seem like a huge difference, but in the world of the Fed, that tiny little drop would be a huge signal that inflation is still heading down, and that could give them the green light they need to just hold off on any more rate hikes. So yeah, pretty much everything is riding on this.
This laser focus on one data point has created this really interesting split personality in the market. It's like a massive tug-of-war between two powerful forces, this deep-seated caution on one side and some surprisingly stubborn optimism on the other. And you can actually see this fight playing out in the data.
First, let's look at the cautious side. And wow, this is a big one. There is a whopping $5.7 trillion just sitting in ultra-safe, low-yield money market funds right now. That is a mountain of cash on the sidelines, and it's a crystal clear sign that a lot of investors are nervous. They're more worried about protecting their money than they are about chasing bigger profits.
And it's not just the cash. We've also got this classic economic warning sign flashing red, the inverted yield curve. This happens when short-term bonds are paying out more than long-term ones, which is the exact opposite of how a healthy market should work. Right now, the 2-year is at 4.20%, while the 10-year is down at 3.85%. And historically, well, this has been a pretty reliable predictor of a recession, so you can see why it has the cautious crowd on edge.
But, and this is a big but, that's only half the story. Because despite all that caution, check this out. Over the last month, growth stocks, which we're tracking here with the S&P 500 ETF, are up more than 1.5%. At the same time, safe, defensive bonds are basically flat. So in this short-term sprint, optimism is definitely winning.
And we're not just talking about the market as a whole. The hunger for risk is alive and well, especially in some of the biggest names out there. While some people are hiding in cash, others are pushing Tesla up almost 25% in a single month. And you see huge rallies from giants like Nvidia and Microsoft too. This tells you that a lot of investors are still betting big on growth. So the question is, where is all this optimistic money actually going? If we follow the money and look at which sectors are hot and which are not, we can get a really clear map of what investors are betting on right now.
And this chart tells a super clear story. The money is pouring into that leading quadrant, which is dominated by technology and consumer discretionary. Home to those high-flying stocks we just talked about. At the same time, money is flowing out of those traditional safe havens, like utilities and areas that get hurt by high interest rates, like real estate. It's a clear vote for growth over safety.
Okay, so that brings us right back to where we started. The market is kind of stuck in this balancing act, teetering on a knife's edge between caution and optimism. So, let's look at the key signposts on the road ahead that are going to decide which way it tips.
Right now, in the very short term, it is all about this week's data, the GDP numbers, and of course, that all-important core PCE inflation report. But we also got to keep an eye on the bigger picture down the road, things like trade negotiations with Canada and that tariff deadline with China in 2025. They're not today's problem, but they will eventually have a big say in where the market goes.
So if you had to boil it all down, what's the final verdict from the experts? This quote just nails it perfectly. Cautiously bullish. The underlying trend is still strong, that's the bullish part, but that pause, that's the cautious part, and you just can't deny it's there. The market is basically just waiting for a clear signal before it makes its next big move.
And so that's where we're at. It all comes down to this one final critical question. Is this big pause just the market catching its breath before the next sprint higher, or is it a warning sign that a more serious pullback is coming? The answer is in the data, and thankfully, Wall Street doesn't have to wait very long to get it.